Welcome to this Killik Explains finance video. This week, 3 things an investor should know about risk and 3 things that are all too easily forgotten. Now, in short, what are they? And then we'll take each one in turn. First of all, managing risk is as important as seeking returns. As markets climb, and recently they have done, this video is shot in April 2017, it's easy to forget that managing risk matters. You can't just forget about it. Number 2, it can't all be quantified. People sometimes over-rely on risk measures, magic numbers, and actually there are other types of more intangible risk that are just important and need to be managed too. Number 3, taking more of it does not guarantee better returns. Fundamental misconception. I'll explain what I mean at the end. Now, managing risk first of all. Howard Marks of Oaktree Capital has said, if we avoid the losers, the winners will take care of themselves. In other words, what he's saying is you need to focus time on identifying stocks that can get you into trouble, weeding troublemakers out of a portfolio, assessing funds, good versus bad, as you do running winners. Somebody else, not Howard Marks, has said it's perfectly valid to spend as long researching a decision you don't take as one that you do. So, discipline is the key. Now, when it comes to risk management, this is a massive area potentially, but here I'm just going to give you a snapshot. What are some rules of thumb? Low purchase prices increase your potential upside. Now, buying something for a low price doesn't guarantee that it's a bargain or that it will perform, but it does limit the potential downside on an investment. So don't forget, core aspect of value investing, going right back to the early days, if you like, and the founders of the science of value investing, buying good companies at cheap prices is crucial. 50% of that equation won't necessarily be enough. Number 2, when there's nothing clever to do, it's a mistake to try to be clever. Now, this manifests in all sorts of ways. People try to time the market. So go back to February 2016, and the FTSE 100 was at 5,500 points. People went into cash in some cases, and then thoroughly regretted it as the market then went up and managed to march through Brexit, the Donald Trump election, and so on, to arrive where it is in around April 2017, at well over 7,000 points. So, trying to be clever isn't always a good idea. And equally, that manifests itself in people wanting to get into the stock market and wanting to buy when actually there's nothing there which is really attractive. So don't move money around for the sake of it. Stick to your long-term strategy and goals. Number 3, make sure you can survive on the market's worst days. And make sure whoever's running your money can survive on the worst days too. It's not enough just to survive the market's average days. In other words, if you're buying a fund, look at the manager's track record. How good were they at surviving really bad periods in the market, and not just can they do well when everyone else is kind of doing well. And that's really important. One of the advantages of active fund management is they can move money into safer assets during periods of risk, but are they doing that? Are they delivering value in bad times as well as good? Now, risk is not just a number, so lesson number 2, if you like, or message number 2. There are many ways you can quantify risk and return. Here are just 4 or 5 magic numbers. Standard deviation, beta, Sharpe ratios, if you're looking at funds in particular. These are all ways, potentially, of capturing risk and measuring it, and I cover all of these in other videos, so I'm not going to say anything more here. If you're into derivatives, which a lot of people watching this won't be, but delta and gamma, these are just names of ways of trying to get a snapshot on risk. But you can't just rely on the numbers. If it was that simple, we'd all make money. What about things that you do wrong, regardless of the numbers, if you like, what I call behavioural risk? This comes down to the fact that as humans, we're not machines, we're emotional, we make mistakes. So here are just 4. Market timing, I've already mentioned. Not a good idea. So many people get it wrong rather than right. And it requires usually 2 calls. If you're going to sell stocks to avoid a dip and then get back in again, that's 2 decisions, both of which could go against you. Anchoring. We fix on historic information that is no longer relevant to today's market environment. Herding. We follow the crowd up into exciting new stories when they're already expensive. That's my point earlier about buying at cheap prices. And we don't get out quickly enough when the market is tanking potentially. And that's known as herding. In other words, stick to an investment approach. Your criteria to sell should be solid and consistent. Your criteria for buying should be solid and consistent. And don't be tempted by other people, media noise and so on, to do anything else. Overconfidence. That is a belief that a bull market is down to our skill, if you like. In bull markets, people get complacent. They assume they're better investors than they actually are, and that can be dangerous. A common misconception then, let's finish on this one. A big mistake people often make about risk. They assume the risk-return relationship is broadly linear. So they'll assume that as they take more risk, they should be making more money, greater returns. But unfortunately, it doesn't work like that. What taking more risk usually means is you increase the variability of the potential outcome. In other words, the highs get a bit higher and the lows also get a bit lower, and your chances of making a loss increase. And that's the point about risk that people often miss. This is meant to be a summary of a sort of normal distribution turned on its side, but you can see that, yes, if you get up there, brilliant, but be aware you could end up down there instead. So that's more like the way the relationship works. So in other words, as risk rises, expected returns tend to rise. Expected being the key word. No one's guaranteeing anything here. Number two, the range of possible outcomes increases, hence the bars on those graphs getting wider. And thirdly, the worst outcome gets worse. So the best day gets better and the worst one gets worse. And your returns are more likely to go negative if you don't manage risk correctly. So there you have it. Lots of ground covered, lots more I could have said. Any questions to the usual place. And if you're wondering about those terms I mentioned, standard deviation, beta, and so on, please see my other videos in our comprehensive library, killik.com/learn.